Well, good afternoon or good morning. Welcome to this video on banking. It's our first video in a series of videos in our last unit on finance. I think there's a lot of real valuable, real world pieces of information and tidbits that you guys could take away that will help you in life. I hope you enjoy this. Before we begin, I want you to open a worksheet that goes with this video. And the very first question that I want you to think about is, what does the banker do in the game of Monopoly? I want you to pause this video and give yourself a chance to fill in that answer. All right, the whole premise of this video is around banking and different financial institutions. In reality, the Monopoly banker does a lot of things similar to bankers in real life. So this video, we're going to talk about a few different financial institutions and what they are and what they're allowed to do, and some of which are banking here. But generally speaking, financial institutions, there's a whole bunch of different ones. In general, financial institutions are able to hold savings deposits. This is when you deposit money. They hold it for you in a safe spot. No one will steal it there. And they will offer you interest. You will be paid to put your money in there. They can give you loans and mortgages. And we've talked a little bit about the difference between a bank loan and a mortgage in class, so I won't spend too much time on it now. They can offer you a credit rating. A credit rating, I'm just going to toggle over here. I pulled up this really interesting article for you guys, and you could look it up yourself. It's from CBC News, and it says how to check your credit report. And if you want to screenshot this and get the exact URL, feel free to do so. But what's really interesting in here is, what is a credit report and why is it important? I've talked a lot about credit reports, and when you're 18, I think you should get a credit card so you can start building up your credit rating in life, because it is the score that financial institutions look at to see if you're worthy of getting their loan, on how much they're going to charge you. A credit score is basically formed based on how good you are at paying loans back, or paying invoices or bills, telephone bills, hydro bills, and things like that. So your payment history forms part of your credit score. How much debt you already have. If you already have a huge mortgage, financial institutions are going to be concerned whether or not they should lend you some more money. Credit account history. If you have an established credit history already, they will have more faith in you that you're going to pay them back, which means you would be a less risky borrower to them. So it's important to have a little bit of credit, have a credit card, like I said, and pay back certain vendors like your telephone provider, your hydro provider, and things like that. Make sure you're paying them back on time. And also, they look at how many other financial institutions have looked at your credit score. So be careful that you're not applying for credit cards all over the place, because the more checks on your credit score actually make your score drop a little bit. What's really important to know, and my husband and I try to do this once a year, is you can get a free credit score report from two organizations in Canada. One is called TransUnion, and the other one is called Equifax. And you can just click on these links here and they'll take you to them. You guys won't have credit scores at this point. So that was your credit rating. Other financial institutions also exchange currency. I'm going to spend a whole slide alone on that. And they also offer stocks and bonds for sale. We've talked about that with our stock market challenge, where you can buy stocks through stock brokers and things like that. Okay, so in Canada, there are many banks, and they're the five big ones. I'm sure you've seen them on many corners in Mississauga. There's Scotiabank. There's Toronto Dominion Canada Trust. They actually used to be separate. When I first got my very first job, when I was in grade 9, Toronto Dominion was my bank because my employer direct deposited my paycheck into the bank. Right on one corner was Toronto Dominion, and the other corner was a bank called Canada Trust. They have since merged, and they are now one organization. There's the Royal Bank of Canada, RBC, we know it as. There's Bank of Montreal, and there's CIBC. Canadian Imperial Bank of Commerce is what that stands for. These 5 banks hold 90% of the money in Canada, which is around $1.3 trillion. If you actually join SHSM, we're going to have a counterfeit detection certification, and a gentleman from the Bank of Canada comes. He's really interesting. He teaches you how to look at counterfeit money and detect if it's counterfeit or not, and he talks about the Bank of Canada and how they make money and shred money. It's really interesting. And of course we have virtual banks. These are banks that don't actually have branches. They are on the internet. For example, ING, which is now called Tangerine, they are an example of a virtual bank. At all of these institutions, banks, trust companies, and credit unions, you can get a checkings account. A checkings account is what I have with my husband. Basically, it covers all of our day-to-day money spending and banking requirements. We write checks, although we write fewer and fewer these days now that we do a lot of our transfers over the internet. We can pay bills directly out of this account, and we can use our debit card to pay directly from this account. We could do direct deposits from our paychecks, like I talked about when I was in high school and had my first job. My paycheck got directly deposited into my bank account. And they also allow pre-authorized payments. So, for example, when Bell Canada invoices me, these companies are authorized to take money directly out of my bank account every month to pay my bills. And a lot of people don't like that, but I find it much more convenient. And I get an invoice from them and I see how much they're taking. I can see how much they're taking out of my bank account. And if there's any discrepancies, I can deal with them directly and we can get that fixed. But generally, it's a very seamless process. Checking accounts do not offer you a lot of interest on the money that you have deposited. So my recommendation is if you have a lot of money, it's best to keep the minimum amount that you need in there. So we try to keep the minimum amount of money in our checkings account to cover all of those bills that are going to come out every month. Our mortgages come directly out of our bank account. The bank takes our mortgage payments directly out of our bank account. So we take into account all of the things that are going to come out and go in from our paychecks, and we try to keep the minimum amount there so that we could put the rest of our money in a savings account. And we'll talk about that in a minute because we get more interest in a savings account. Most bank accounts, especially checkings account, charge a transaction fee. So sometimes you're allowed 1 or 2 free transactions or writing checks per month as an example. However, if I write a third check, they may charge me 50 cents or $1 just to write that check. Another charge that might come out of your bank account is let's say I were to give you a birthday check. It was your birthday tomorrow and I wrote you a check for $100 and you went to the bank and you cashed that in your checkings account. And I didn't have enough money in my bank account to cover that. You've heard the term bounce check before. Well, that's what an NSF check stands for. This stands for not sufficient funds. And because my bank account didn't have enough money to pay your bank the $100, they would charge me and possibly you for having that check bounce. And often it's frustrating if someone writes you a check and you have to pay a fee because that check didn't go through. Savings accounts are much better if you have a lot more money. It will accumulate interest. The interest rates are a little higher in a savings account than in a checkings account these days, but still, trust me, they're not a lot of money. And the bank gives you more interest to lend that money out and to invest with. So the money you put in the bank actually doesn't sit there in an account waiting for you. The bank takes all of the money on deposit from all of its depositors, actually lends it out as mortgages and loans. They have formulas to tell them how much money they generally should have in-house for people who are withdrawing money on a daily basis. But I can tell you if everyone who had money on deposit at a bank came on the same day and tried to take all their money out, they wouldn't be allowed to because the bank wouldn't have it there. Banks make money on your money. Okay, mortgages. We've talked about mortgages already in this class once or twice, but mortgages are loans that are given to people in order to buy property. It's a bank loan. Most of us have mortgages. Most of your parents would have mortgages. And what happens is you go to the bank, you ask to borrow the money, you fill out the forms, they check your credit score, and then they determine whether or not they're going to lend you the money. And it's a promise to pay back the mortgage over a period of time. Could be anywhere from 5 to 25 years, almost 30 years these days. Actually, they have mortgages for 30 years. And they charge you interest. Now, in order to get a mortgage, you have to have collateral, which would be your house. So in exchange for borrowing the money, you put your house up as collateral. And if you default on your loan, which means you don't pay it back, the bank has the right to take your house away from you. Line of credits are really valuable tools that I suggest you get. Basically, it is similar to a bank loan. It's a source of money that you can access if you have a good credit score and you've applied for the line of credit and they've approved you. But the difference between a bank loan and a line of credit is a bank loan you take, if you borrow $10,000, you get the whole $10,000 right away and you start paying interest on the whole amount. If you have a line of credit for $10,000, basically, you have access to that $10,000. If you don't ever touch it, they don't charge you interest at all. But if you need some money, let's say you only need $100 this month, they will only charge you interest on that $100. So it is really valuable to have a line of credit. And for example, and we're going to talk about credit cards, I always say if you can't pay your credit card off every month, the balance that you owe, which is 19% interest on most credit cards, then you need to borrow the money from your line of credit, which is a much lower interest rate, 3 or 4% these days, in order to pay back that credit card. I know you're taking credit and transferring it to another credit situation, but I would rather owe money on my line of credit at a lower interest rate than owe money on my credit card. Line of credits are often taken out for education, renovations, and things like that. We always have a line of credit, my family, so that if there are situations where we need access to money, an emergency situation, we have access to it at all times. There are other investment services, GICs you've heard of. This is a great place to save money if you have more money than you would want to put in a savings account, because savings account don't give you a lot of interest. You would earn more interest in a GIC than you would. So basically, it's an investment of a principal. So this is the money you put in, $100, let's say you invest. And you can't withdraw it for a certain amount of time. 6 months, a year. And then after that fixed term, the 6 months or the year, you will get your money back plus an agreed interest rate. Often people just buy GICs and then keep reinvesting the GICs plus the interest, and it keeps growing that way. Again, the interest rate is higher than your savings account. You've heard of mutual funds. These are a combination of different stocks and bonds, and we talked about them previously, but basically a little bit safer than just buying individual stocks and bonds, because if you have a whole basket of different stocks, if one of them or two of them are doing poorly, hopefully some of the other ones are doing better. It is a just less risky situation for you to be investing money in. All right, currency exchange is another thing that financial institutions are responsible for. Right now, the Canadian dollar is really bad. A couple of years ago, the Canadian dollar was on par with the US dollar, meaning they were equal to each other. Right now, the Canadian dollar is sitting at about 70 cents of the American dollar. So I'm going to flip over here. This currency converter, you can do it on your own. But I just wanted to show you that right now, I pulled this up. So as of today, the conversion rate is 70 cents, they say. 0.7087 right now. If I exchange one US dollar, they would give me 71 cents Canadian, or 70 cents Canadian. So if you were to go to the States and you want to convert your Canadian dollars to US dollars, basically you would need $1.41 of Canadian to buy one US dollar. That's terrible. So all of you who are planning to go away on March break and you need US dollars, it's really, really a bad time to exchange your money. So how do you get this 71 cents to $1.41? Basically, if you take 1 and divide it by 71, you will get the $1.41. But lots of people just use these converters. We're going to spend a whole video on credit, but right now, just in brief summary, I suggest as soon as you turn 18, you get a credit card, because it will help you build your credit rating if you use it and pay it off fully every month, and you're never late paying. I suggest you get it, buy a couple things every month when you have the cash for it, and then when the bill comes, pay off the bill. So how do credit cards actually work? You go and you buy things, you use your credit card. Eventually, within a month, you will get a bill that you would need to pay on a certain day every month. Every month, my credit card bill is due on the 22nd of every month. If I pay on time, I have no fee, usually. Some credit cards charge you a fee just to have them, but I suggest you get a free credit card. However, if I pay late, there is between 18 and 21% interest on credit cards. Very, very expensive. You should never, ever carry a balance on a credit card just on that fact alone, which is why earlier I was saying, if you have to carry a balance on your credit card because you can't pay it for whatever reason, you should use your line of credit. It is a much lower interest rate. You could use your credit card when the bill comes, take the money from your line of credit to pay the credit card, and then pay your line of credit when you can. So just as an example here, 19% interest on a $130 pair of shoes. If you don't pay that after a year, that's an extra $25. It's almost 25% right there, 20% just for those shoes. And like I said, we're going to talk about credit in another video. Hope you found this video helpful, and we'll see you tomorrow.